That's just funny. Should I chew gum while I do it? All right, you ready to rock?
A few moments later.
Rolling, testing 1, 2, 3. Lots to talk about today, folks. I thought since the agreement of the US and China and the tariffs coming together, where it looks like they're being happily ever after, and now the markets have risen, everybody seems happy, everybody being upset about what was happening before where America couldn't make friends or have good relations with any foreign party, it looks like we are in a positive step forward and the markets like it. Now, what does this all mean? Well, to me, it means that we should be focusing on what could still go wrong because it is a very normal occurrence for there to be volatility. I still frankly believe, not that I'm taking a defensive position, not that I'm telling you go in cash, not that I'm making any crazy shift into any of our client portfolios, but I still believe it is very normal for there to be a 20% drop in the market. Sure, we had 2024, that was just fine. We had 23, that was fine. 22 with a 20% plus drop. And when I start looking how many 20% drops that we have had since 1929, we've had 15 drops if you count the drop that happened this year. Now that was more on the NASDAQ, but it doesn't matter. We've had 15 per times that the market dropped 20% or more. Now, we've had 9 times where the market dropped 30% or more. We've also had another 5 times where, we're dropped 40% or more. And then at 50% drop or more, it's been 3 times. So it has happened. It's not uncommon for it to happen. And quite frankly, when you look at since 2008, how many drops that we really had, what did we really have? Seriously, we had 2018, 2022? Like we really haven't had that many drops. So for me, I thought, hey, let's have fun. And to have fun, let's talk about what are the potential scenarios where the market can drop. And I put a list here together of about 9 things. Technically, there could be 10 things, which if we have time, I'll discuss. But I want to talk about the 9 core things that can happen on how the stock market could still drop over 20%. What are the scenarios that can affect you and your portfolio? Do I think it's going to happen? Yes. I just don't know when, because it's a normal occurrence for it to happen. So I'm going to highlight the items that I think could be the reason that the portfolios could drop 20%. So you have to ask yourself, what did you do earlier this year when the markets were down? Did you freak out? Did you go cash? Was this time different because our president was crazy and making some aggressive negotiations? Well, he was crazy yesterday and seems pretty smart today. Regardless of the decisions that are made in DC, you have to continue to stay disciplined. And when you take a look at the potential drop of 20% or more and the scenarios that I'm about to discuss with you, you have to see if you are prepared. That's the biggest question that you should be asking here is, are you prepared for a market drop? Because it can happen, and here's the big thing that nobody wants to say, but I'm going to say it, it's going to happen. So what are you going to do about it? So if you're going to ask me why, no, I'm not going to focus on politics here. There are geopolitical reasons, but I'm going to try my best not to say Trump's name once. I got to get it out of my system. Trump. Okay, I got it out of my system. Now I'm not going to try to say it for the rest of the time. Let's see how I do. Let's talk about the first one, right? You can have the first reason could be something as simple as like an economic slowdown, or heck, even an economic recession. And when you start looking at something like persistent high inflation or aggressive central bank hikes, this could be the Fed Reserve or whatever the case is, you could see this reducing corporate earnings, and which affects us and our investor confidence. And when our confidence is hurt, we stick in cash. And when we stick in cash, that does affect markets, especially when you see a massive sale. So the first things first is looking at truly the economic situation, because if we have rising unemployment rates, these are things that are all indicators and signs. And quite frankly, we had a recession in 2022, but because we had low unemployment, our government did not want to call it a recession. Now, come to find out in hindsight, about 75% of those jobs were government jobs they were hiring for, but let's not digress. Number 2, this one is a big one. geopolitical instability. Now, when you look at geopolitical instability, this could be something as simple as the U.S. having tariff wars with the world, or U.S. and China really combating each other. Now, it looks like they've kissed and made up, but the idea is what? Maybe that's just for now. Maybe somebody doesn't hold their end of the bargain. Maybe there's a new situation or opportunity or technology that comes out where we want our fair share. Last I checked, TikTok is still owned by China. So the idea is what? There could still be geopolitical issues that do pop up. And oh, by the way, there's still no peace in the Middle East. We still have Russia and Ukraine. Heck, we just had India, Pakistan. God knows what other issues are going to pop up around the world. So yes, this does matter. And so trade wars are real, sanctions are real, and this does affect corporations and profits. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every week. And we're talking about all important topics of personal finance. And today we are talking about what are the reasons why the markets can drop 20% and for you needing to be aware. We're going to go number 3. Number 3 is something kind of deeper in the weeds, and this is the overvaluations of companies. When you look at price to earnings ratios and the overvaluations of these, when you take a look at tech-heavy indices like the NASDAQ stocks may be overpriced. When you look at vulnerability to corrections based on that, taking a look at bubbles, whether it's in cryptocurrency, whether it's in AI, whether it's green energy, these are all simple things that can just burst. When you take a look at some of these AI companies and the not millions, not tens or hundreds of millions, but the billions of dollars that they are losing and the collective amount that it's causing with this infusion of capital because everybody thinks Terminator is going to come and save the world and it's going to drive prices down. I just don't see it. I really don't. It's basic economics the way these things work. Unless there's an extreme supply, and the conversation I was having with a techie earlier was about eggs. Eggs could be a lot cheaper. Well, because if you have robots going out there and getting the eggs that don't call in sick, that work 22 hours a day because you have to swap out their battery, that do a job flawlessly, the only way eggs can be cheaper is if all of a sudden, because they have these robots that are working nonstop, we have a surplus of eggs. Well, when you have basic economics, guys, I learned this at 19 years old in Economics 101 class at Arizona State University. There's a lot of eggs on the shelves. That's high supply. If it's the same amount of demand, they have to give it cheaper eggs to us. So I just don't know. That was one example with eggs. We got a bazillion other things that are out there. I personally don't see that the prices are going to go down. With an egg is costs 50 cents. If I was in the business of selling eggs, if I save more money doing it, I'm still going to charge 50 cents, even if it costs me half as less to produce that egg. Not going to be able to look at eggs the same after that conversation. Let's talk about number 4, monetary policy missteps. This is something as simple as if the central banks tighten their policy too quickly, fail to cut rates, which they've been talking about, they really haven't done. God bless Chairman Powell here. If that happens, then you could have liquidity that does, in fact, dries up, which hammers asset prices. And then when you look at yet again, the loss of confidence in the central banks, this could be credibility, could trigger a potential, right? Everything's potential, a panic selling. All of this stuff adds up, folks. I'm trying to tell you. These are just reasons. All we need is one headline, one purpose, one thing to drive the market that is a logical approach where we see not just qualitative, what I'm talking about, but quantitative reasonings of things not working out for the markets to get slapped in the face. So yeah. These are all valid things that can happen. Oh, by the way, it feels kind of real. Why? Because it is. These things are happening, just not to a massive scale. All we need for that to happen is for it to happen. Number 5 is debt and financial system stress. This could be something like high corporate or government debt levels could become just like unstable, especially if there's like interest rate risk of refinancing becomes difficult. I mean, that is a real thing that's out there. Heck, you saw a couple years ago in these companies that were losing billions of dollars on the brink of bankruptcy, where they had to refinance their debt. The banks who issued the debt, the servicers who issued it, had to restructure the deal or they would have defaulted and they would have never gotten their money back. So these are yet again real concepts that are in fact happening. This happens on a larger scale. Yes, that can be a problem. Heck, you can have major bank failures now. You can have some like credit market freeze situations. These are real situations that happen, and we saw that in 2008 with Lehman Brothers. So yeah, things seem great right now. Everybody's happy. Their 401ks are back up. The millionaires are now more millionaires. The rich got richer. But what did you do in the process? Did you panic during it? Do you still think the market's going to drop? Because if you do, you are correct. Of course it's going to drop. It's going to drop 20%. Happened 15 times in almost the past 100 years. It's going to drop 30%. Happened 9 times in the past almost 100 years. 40% drop. Oh, it's totally going to do that. That happened 5 times also in the past 100 years. And then, of course, you know there's going to be a 50% drop, which on average happens about 30 to 35 years. So it's going to happen. It's normal for it to happen. The question is when. So when we come back, we're going to go on the second half of how we're expecting a market drop and the things that could be happening where you should keep your eye out there, but do not lose sight of investing. So we'll talk more about that when we come back. This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business, talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions, and also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, and fill out the form fill right there on our site. Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And we are going over just the reasons why the market's going to be able to drop at least 20%. Now, I don't know when that's going to happen. That's the whole shtick to the whole idea. But I'm sharing, based on today's situation, why the markets can drop 20%. And you have to be prepared for that. Your portfolio can't just be all in big tech, or can't be in an individual stock, and can't be just in the S&P 500. Because you're going to be riding the wave. And what a lot of people forget, and this is why some of the best investors in the world, this is why Warren Buffett believes in diversification, is because from 2000 to 2009, if you invested in the S&P 500 for over 10 years, or 10 years in my example, you would have been down 10% roughly, with no fees at all, no management costs or anything. Well, 10 years, imagine investing for 10 years and not making a damn thing. You know what we call that? Crappy. That is not good. That's a professional term for it. That's a crappy situation. So do you want a crappy situation, or you want a good situation? This is why diversification is key. There's a cost to that sometimes, especially as we're in roaring bull markets. All I'm here to say is that market drops, bear markets, crashes, and recessions are a very normal part of economic cycles. So we went over the first 5 reasons why the market's going to drop 20%. Yet again, I don't know when. It could be 20 years from now. It could be 20 days from now. Hell, it could be 20 hours from now. The idea is we went over the economic recession or a slowdown, geopolitical instability, overvaluation and market bubbles, and then monetary policy, and then number 5 was debt and financial system stress. So now here I'm talking about number 6, as we're going over the reasons the markets can be dropping over 20%. And this is based on now what I put together. Number 6 is supply chain and commodities shock. So I bring this up because we've seen supply chain disruptions before, especially during the pandemic or natural disasters, trade restrictions, whatever the case is, we have seen it happen. And this could drive costs higher, squeeze corporate margins, which of course, less margins, less profits, markets drop. And when you look on spikes of energy or food prices, could reignite inflation, forcing tighter policy and market declines. These are all situations that could add up. So when you take a look at this and what type of impact this could have in your portfolio, yeah, it matters. Heck, we saw in eggs just recently with, what was it, the chicken flu, swine flu? I don't know what the heck it was. I just remember it cost like $2 an egg. That's crazy. But these things happen. We've seen it with tomatoes, we've seen it with meat, we've seen it with many things. And heck, we saw it with toilet paper during COVID crash. So number 7, investor sentiment and technical factors. Now, when you take a look into this, you look at a shift from people being, as Warren Buffett says, when those are fearful, be greedy. But when those are greedy, be fearful. So when you start to see a shift driven by bad news, which could lead to like margin calls, which could lead to mass selling, especially in high leveraged markets. Well, this could be like trickled from algorithm trading and stop loss orders. This could amplify declines, creating a feedback loop that really, when you take a look at like the 1987 Black Monday crash, I mean, that was really by program trading when you really look into it. So this is why you've now seen markets jump in and stop the market, stop the selling and freeze. This is extremely impactful, but this could be reasons why the markets drop. This could be a reason we see a 20% drop, because all of a sudden, if all the indicators hit and everybody sells at the same time, well, there needs to be a buyer on the other end. Now, I will give credit to the consumers, to the people, to the investors. Why? Because they've been smart enough now to, when the markets go down, they actually infuse capital. I know here at Falcon Wealth Planning, when markets drop, we've trained our clients to actually put money into the account. They actually send money into the firm. So it depends on the person for sure. But as Warren Buffett said, sitting on $350 billion in cash, I don't get excited about the markets down 10 to 20%. He referenced something like he's experienced 3 or 4 or 5 different times the markets dropped 50% or more, or his portfolio dropped 50% or more. And he said nothing was wrong fundamentally with the companies. So that is a logical approach. But these are things you have to take into consideration. Number 8, you can have global economic issues. Now, we kind of talked about this a little bit, but this could be like a crisis in a major economy. We saw this in Japan in the 80s and 90s with their real estate. Massive recession and decline and crash. To this day, they haven't fully recovered. The psyche of the individuals there in Japan still never has been back to where it was back at those times. So this could be something like maybe China's property sector could have issues. This could be Eurozone debt issues. They're a very leveraged place over there. This could spill over and impact global markets. Heck, emerging markets, defaults, currency crisis. This could all just have issues on our sentiment and appetite to invest. These are real things that could make serious impact, that just make us uncomfortable to put our money and invest it. That trickles to the markets. If there's not enough buyers, they have to go down in price to entice buyers. The stock market is a market. It brings buyers and sellers together. Well, if you don't want to buy what I have to drive the price lower and lower and lower until you finally say, you know what, it's worth the price that it's currently trading at. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. Today, I'm just going over some of the ideas of how the market can drop in today's climate of 20% or more. I'm going over all of them, seriously. So this is where I would love kind of feedback if you think this is something that could be added to this. Yet again, I am not talking about politics, and I refuse to say the word, if you remember from the first segment, and I still haven't said it. Number 9 is regulatory and policy shocks. Now, this could be something like an unexpected tax hike. Now, we're actually currently seeing that our current administration has been putting into Congress that certain tax proposals. So some of these are actually more positive, more good than bad. But yet again, let's just say it doesn't go through and the taxes revert back to what it was back in 2017 and prior, then there could be some issues. But there's also could be antitrust actions against some major firms that are out there. There could be regulatory crackdowns, whether it's on tech or energy. This could really put a dent in profits and just overall sentiment in general. And we've just seen this. We saw this in China in 2021, by the way, with the tech crackdown that led to sharp declines in its markets, with, quite frankly, global ripples. So yes, these are all things that add up, as crazy as it sounds. Like, If they were to take the solar credit away, what do you think that happens to the energy industry? What do you think that happens to Tesla? What do you think that happens to solar companies? What do you think that happens to people driving EVs, where right now they're getting $7,500 credit? It matters, folks. There are ripple effects that happens to all of it. So just beware, be on the lookout. Take a look at your financial situation and decide and ask for yourself, are you in position to take on any one of these situations? Are you concentrated in any one investment that you're able to take on any one of these situations? This is why, as our boy Warren Buffett says, it's so important to be globally diversified. Now, the final one is a Black Swan event. What is a Black Swan event, you ask? Great question. This could be like maybe a global pandemic. We heard of that? Nobody could anticipate that, right? How about a massive natural disaster, God forbid? Southern California gets a lot of earthquakes. Well, they're the fourth largest economy in the world. God forbid. There's many different areas. There could be massive tsunamis. It can go anywhere in the world where there could be massive problems. There could be war. Escalated and aggressive terrorist attacks. Cyber attacks is a new thing. Well, not really a new thing, but something that we've seen that can cripple the airline industry, that can leave hundreds of thousands of people stranded because the computer can't coordinate flight logistics. These are true things that can really continue. You can have, of course, the natural unpredictability of anything that can disrupt markets in general. When you take a look at COVID, or you take a look at inflation and interest rates, when you take a look at global geopolitical political risks, valuations of companies, debt levels, the sentiment, all of these things truly matter to help you make the right decision. But one thing remains the same. All the bad things that can happen to you, that can happen to markets, that can happen to the world, we live to wake up another day. And let's just say you don't, somebody does. Unless we're talking about a global collapse and an Armageddon, like truly an Armageddon where nobody wakes up. Even if, God forbid, there was a massive earthquake and 50% of Californians died, well, guess what? There's 50% that live. And the idea as humans, and corporations are ran by humans, is to prosper, is to live, and is to survive. And markets, no matter what, know how to do that. They will always figure out a way to eat, to hunt, and to profit. And this is part of capitalism. And yes, there are times there are in fact government help, but this country in particular is based on what? Us being able to make as much money as possible if you have a right idea, if something that can be innovated, something that can change the world, to enhance lives that people are willing to pay for. This is the beauty of capital markets. And not corporate greed, because that is sometimes the negativity of capital markets. Because they'll actually withhold something for you, even if it's good for you, just so they can make more money. I've heard it before. Why would I treat you or cure you for $1 if I can treat you for $10? This is where some of the negativity can happen in capitalism. But our job right now is to keep that open mind and stay disciplined. All of these scenarios here are situations that can put you where you can lose 20% of your portfolio or more. We know the risks to investing, but there are also rewards to investing. And by staying disciplined, we know those rewards could be what? S&P 500 annualized 10% returns. That's net of the 20, 30, 40, 50+% drops that we've seen in the markets. You don't want to time the markets, because missing one day could significantly reduce your overall return. Sometimes I tell people you're too smart for your own good. I wish you lost money and not timed it right, because you can't time the market right once. You have to time the market right twice. Not only when to sell, but when to buy back in. Hopefully, folks, this was very helpful for you. If you have any questions, reach out to us. But man, oh man, that was a fast show. You just ruined it. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. I want you to have a fantastic weekend. Have a great week, and God bless.